On this edition of Money Life, Sam Toombs, chief U.S. economist at Pantheon Macro, gives his take on economic growth.
Right now, we see an economy that is struggling. No, it's not close to recession, but I think in GDP growth is probably more like 1% rather than the 3% rates that are being reported right now by the latest official data that we have. The labor market usually gives you the better signal as to what's happening in the economy. And there we can see, employers being very cautious, jobs growth slowing, and many of the forward-looking indicators that we track from surveys in particular now look very soft. So I think we're in a slow growth phase for the economy. That's likely to persist at least for the next 6 months.
Tom McClellan, editor of the McClellan Market Report, talks about what things like the Hindenburg Omen mean for the market right now, but also gives his take on what he expects for the long-term future.
For about the next 15 years, it's going to be a great environment to be a market timer. It's not going to be a great environment to be a buy and hold investor like the last 15 years have been.
Plus, Seth Brufsky, chief executive officer at Ares Dynamic Credit Allocation Fund, is here talking about how this rate cut cycle will impact high-yield bonds and much more.
Here comes the good part.
Yeah, absolutely. The good part's where we start talking. And you get to hear a lot more than just those little snippets of interviews. This is Money Life for November the 7th. I'm your host, Chuck Jaffe. Thank you so much for joining me. We have a great show planned and executed for you today. Sam Toombs makes his debut on the show, chief U.S. economist at Pantheon Macro. There's a lot in that interview for you to listen to. His take on what's been happening with tariff revenues might interest you. The outlook for the economy, where he's pretty good. And also, he's talking from across the pond, where at the end I ask him a market question, which I'm always a little concerned about doing when I talk to an economist, because not every economist also really does stuff on the market. But I really wanted more his perception about valuations and things, because everybody here talks about what's happening over there. And I just wanted to see if the perspective is reversed. So it's an interesting question that'll be the capper on that interview. Tom McClellan, veteran market observer, has talked about how he expects long-term pain in the past. He actually has a very, very mixed report today, because the Hindenburg Omen is a thing that's been happening all week on the market. In fact, I wrote a piece for thestreet.com, which we will make available. Follow on Twitter, on X, because I will tweet about it once it's up today. But the Hindenburg Omen, that's short term, that's happening this week, and it could portend some bigger things. Then you've got a short term forecast that is ugly for a while, but he's a believer in calendar effects and presidential election cycles. So he thinks 2027 will be great, but he doesn't think it's going to be great getting there. And then you've got the long-term picture, which you just heard a snippet of. And the navigator actually starts us off today. Seth Brufsky from Ares Dynamic Credit Allocation Fund. He returns to the show for the first time in quite some time. We've had a couple of guests who have talked about junk, high-yield bonds, where they disliked spreads. And they were talking about spreads and how it wasn't worth it necessarily to go after the high-yield segment when the spreads were not great and you could get a solid return on treasuries. That's not necessarily what you're going to hear today, because I do ask Seth about spreads. I'm Chuck Jaffe, financial columnist, journalist, your host here on Money Life. The show is independent personal finance talk and market talk. We'd love to hear from you, Chuck at moneylifeshow.com. Again, if you are one of the folks who has fought through the fact that our show has not appeared on Apple Podcasts for over a week, thank you for sticking with us. Please tell anybody else in our audience, we're here every day. I very much appreciate you guys making that effort to be here, because we make an effort to be here for you each and every day. We also make an effort to keep this show on time. So I'm going to cut this short and let's get to the talking, because I'm going to let that go long. Again, our lineup starts with Seth Brufsky, then Tom McClellan, then Sam Toombs. We'll be back in just a moment with The Navigator.
Immerse yourself in the world of closed-end funds, interval funds, business development companies, and more at the annual Active Investment Company Alliance Roundtable, November 19th in New York City. You'll hear from money managers, financial advisors, fund sponsors, and more. many of them familiar to you from The Navigator here on Money Life, as they discuss the latest trends, investment strategies, and developments in closed-end funds. Complete details are available at aicalliance.org/event. Use the code MONEYLIFE20 for a 20% discount.
We're talking about the rate cut cycle with Seth Brufsky, Chief Executive Officer at the Ares Dynamic Credit Allocation Fund. This is The Navigator. Welcome to The Navigator, where we talk about all-weather active investing and plotting a course to financial success with the help of closed-end funds. The Navigator is brought to you by the Active Investment Company Alliance, which is a unique industry organization representing the full spectrum of the closed-end fund business, from investors and users to fund sponsors and creators. If you're looking for excellence beyond indexing, The Navigator is going to point you in the right direction. And today, we're looking at how rate cuts are impacting the high-yield, leveraged loan, and collateralized mortgage obligation markets. We're doing it with Seth Brufsky, Chief Executive Officer for the Ares Dynamic Credit Allocation Fund. It's ticker symbol ARDC, and you can learn more at arespublicfunds.com. Ares, A-R-E-S, arespublicfunds.com. If you want to learn more generally about closed-end funds, interval funds, and business development companies, go to aicalliance.org. That's the website for the Active Investment Company Alliance. Seth Brufsky, thanks for joining me again on The Navigator.
Thanks, Chuck. Looking forward to it.
We are early stages in a rate cut cycle. The market is clearly expecting more. At ARDC, you are looking to generate income and attractive total returns. You're doing high yield, leverage loans, and CLOs. What happens to those markets in a falling rate environment?
It's an interesting mix of assets in a falling rate environment because on the one hand, you have exposure to high yield bonds, which are fixed rate. Therefore, technically, if rates come down, the prices of those bonds should go up. And our goal is to actually find the bonds before that happens so we can take advantage of the capital appreciation, while at the same time, we're creating a base of very strong high yield bond investments that you can't replicate as the price actually goes up. On the flip side, the CLOs, collateralized loan obligations, and leverage loans are all based off of SOFR, which is obviously a floating rate benchmark. So you would think as rates go down, you'll collect less interest associated with those investments. However, there's a little bit of counterintuitiveness that goes into that because as rates come down in the CLO market, new issue CLOs are issuing their liabilities at lower rates. So you're actually improving the arbitrage opportunity in the CLO market. That enables you to take advantage of the fact, even though you're in a floating rate instrument, to take advantage of the fact that rates are going down. On the leverage loan side, because it is floating rate, one of the benefits is actually you're improving credit quality in those loans because essentially as SOFR comes down, those companies are actually having to pay out lower interest coupons each month or each quarter or each 6 months. So they actually have more cash flow to attend to their business. So you're actually improving credit quality. So on one hand, while you're actually receiving fewer interest payments, you're actually having a stronger investment.
You're talking about where rates can go. Treasury rates, I've talked to plenty of people who don't think they're going to respond to the rate cuts. Does that wind up playing into any of this? I recognize the tie to SOFR, but if we're looking at the different asset classes, is anything that's more tied to treasuries more likely to perform differently? Like if you're looking at the three asset classes that you deal with, which one's going to be best? And is there one that is different because of that?
On the baseline of everything, high yield bonds from a price perspective should perform better just because they are fixed rate. So as the treasury rates come down, bond math says the price has to go up of the instrument, assuming all else is equal, of course, meaning that the credit quality of the company is the same. The risk premium you're assigning to holding that asset is the same.
In the high yield space, the issue has been spreads. So what we're saying there is it's going to become a more attractive environment there. Will you see the same kinds of gains elsewhere, or in a falling rate environment, high yield is going to be the place where you want to go?
I think it all depends on the reason why rates are coming down, right? If the reason rates are coming down is because you believe inflation's coming down, great. If you think rates are coming down because the economy is going to be much worse, I'm going to say much worse as opposed to on sort of more of a glide path to lower positive performance. If you believe that the economy is going to be doing much worse, that's going to hurt all asset classes, right? Just the performance, the credit risk premium above the treasury rate or above the SOFR rate is going to widen out. So it really depends on the reason why rates are coming down. I think in the current environment, and the reason why we're seeing rates come down is not that instance. So our view on spreads, putting aside interest rates for a moment, is that they should be pretty well within the ranges that we have today, which are pretty good. Unless we have a recession, you're not going to see the risk premium spike. But where we stand today with sort of low single-digit growth rates, there is stimulus through a lot of the programs that the current administration is putting through that should help offset any sort of slowing in the economy, that we're in a pretty good range to take advantage of the rates markets the way that they are trading and the spread premium that we're getting for the instruments that we hold.
You use the word taking advantage. At ARDC, you are actively managed. Not all of your competition is. And of course, we see times when active management pays off and doesn't pay off. But rate cutting cycles, is that when we would expect there to be a payoff to active management?
There should definitely be a payoff because it enables you to shift your portfolio. You just like being in all three of these asset classes rather than just say one, just in leverage loans, CLOs, or high yield bonds. It just opens up the universe. I mean, also when you look at a place like Ares Management, we do a lot of different things within credit that enable us to see a pretty wide funnel of instruments, of assets that we can invest in. If we find a good investment, we can always find a good home for that here at Ares. So we're sharing a lot of deal flow, a lot of idea flow between the other parts of Ares that enable us to do that. But in terms of active management, it all comes down to, if you think rates are coming down and you think fixed rate is better, we're going to access the high yield bond market. Whereas a specific leverage loan manager, if it's just 80 to 100% leverage loans, is going to be stuck in a lower income asset class at that point in time. So they're not going to be able to shift their portfolio, and vice versa for that matter. So active management, I think, should really be advantageous in either a rising or a lowering interest rate environment, just because the opportunity set is that much bigger for you. A lot of people can say, we'll do CLOs as an example. Not a lot of people are familiar with CLOs, right? And not having that expertise is a really good way to make mistakes. You can't just blanket say, I'm going to go into the CLO market because it's providing me better income than loans or high yield. You need a team who's been doing it for quite some time to identify what those opportunities are, because then, you end up making mistakes just saying, I'm going blanket going into some asset class that looks better.
The asset class more generally that everybody's been trying to get into has been private credit. There's a lot that goes into the private credit market, but there's a lot that's going into funds. And anytime you have a rush of money into a whole bunch of things and you get some of those less experienced managers going, wait, hold it, here's where the demand is, you wind up having blow-ups. They are not easy for the public to sort out and find. But are there hidden risks in a portfolio like yours? And what do you, or should any fund manager, be doing to address them so that we wind up liking private credit and not going, told you so, there'd be a blow up there?
Right. And I definitely, for the folks who obviously were on podcast, they can't see me shaking my head when you're saying, as money flows into an asset class, mistakes are always made. People always run to an asset class thinking that they can easily set up business, and underwriting standards definitely do change when there's more capital chasing the same ideas. So the idea is really to grow the pie. A lot of it comes down to experience. I mean, the easiest thing to say is we're an asset manager, we're getting money to manage assets. Do your diligence. Simple as that, right? I mean, it sounds simple. It's not so simple. You need a pretty big team to be able to do it. It's obviously some of the specific names that people have seen blow up in the last few months. Those were more fraud related, and it's very difficult to diligence fraud. However, those managers with experience who are doing their diligence, I think, should have enough experience over the course of time to see those warning flags. To your point, a lot of money rushes into asset category X, whatever. In this case, you're talking private credit, or wherever it is at any given time. And people do go, I need to ramp up my portfolio, therefore I'm going to stretch my underwriting standards. That's a difficult place to be. Fortunately, we at Ares are not in that space just because we have experience, many, many decades of experience in all the asset classes, being pioneers in many of these asset classes. And the other thing is, as it relates to ARDC, we're very well diversified. You're talking about a portfolio that has 250 to 300 names in it. So you don't really have position sizes. If you do make a mistake or you do have a fraud mistake, it's really well contained because of the diversification that we have. And then on top of it, say it's in any specific industry. In this case, there's a lot of talk about in the auto industry, over the last couple of months. Our exposure to autos is, it's less than 3%. Right. So we're diversified, just not by single name, but by sectors. There's 30 different sectors that we're investing in across these different portfolios. So, in terms of hidden risks, I would argue that we all make mistakes, right? We all want to bat 1,000, but we all make mistakes. And the idea is to make sure if you make a mistake, you do two things. It's contained. And we also have a policy called first sale, best sale. Meaning that if something doesn't smell right, our universes to invest in are big enough that we can sell that asset, buy something else to replace it pretty easily. Our markets are very, very liquid to be able to do that. If you're wrong, you can always go back and buy that asset. It might cost you a quarter or half a point if you're wrong, like it didn't blow up. But if you're right that it did blow up, it's costing you, in the case of a couple of these names, they traded down 50 to 75 points in a week, which is very, very painful to be able to do. And, it's just, taking it one step further as it relates to Ares itself, we're able to tap in across our platform to get a lot of information flow that might be a little bit different than some of our other competitors out there in the market. So we're checking in with our cousins on the corporate private credit side. How are their companies performing? Are they seeing any warning signs in any specific type of company or sector? And then we, vice versa, can go back to them. This is the way that we're seeing stuff trade in our market. Just being able to tap into that really helps us quite a bit in avoiding that. And that's led us at ARDC, our default rate is 0%. Where the market, high yield bonds with liquidity management exercises, which is another one of those things that's been happening, is somewhere between 2 and 3% for high yield and leveraged loans. So over the course of the 12 years we've been doing this at ARDC, we've had minimal defaults.
As you look at the lessons of 12 years, is there one particular one that stands out that maybe when this all started, you wouldn't have foreseen sharing 10 years, 12 years into the future?
Again, getting that due diligence, right? Like if you have the ability to have this large funnel or first just have access to such a broad platform or get as much information as you can never get enough information. Now it's your job to parse through that information as one thing. But I think, active management very much helps is one of the lessons that we've learned, because it's easy to make an investment and sort of stick it in a drawer. Then there is a factor of, you got to cross your fingers a little bit that you made the right ones, right? You have to be able to recognize if you made a mistake, minimize that mistake. I've seen too many people who can talk themselves into holding investments. I always used to say, you should love it at par. You should marry it at 90. You should let the in-laws move in at 80. But once it gets below that, it's a little bit past the true love that you might see in any given market. And you're really got to be careful about talking yourself into investments, because as an active manager, getting back to that point for a second, you can really open your universe and your options are there to be able to minimize your loss on something that just isn't going right.
Seth, glad that we got a chance to catch up and talk about it. Look forward to talking with you again on the Navigator down the line.
Thanks much, Chuck, and good luck to all your listeners out there. It's a fun time. There's a little bit of stress out there, but it's fun to be in that environment.
Seth Brufsky is Chief Executive Officer for the Ares Dynamic Credit Allocation Fund. That's ticker symbol ARDC. You can learn more about it at arespublicfunds.com. Later on Money Life, Sam Toombs of Pantheon Macro makes his debut in the big interview. But next, we're talking about the Hindenburg Omen and much more with Tom McClellan of the McClellan Market Report. Sounds ominous indeed.
Logic dictates that given their extremely high level of technical development.
Well, it's too technical to explain to the lay mind.
Welcome to Talking Technicals on Money Life, where we don't think that technical analysis is too hard to explain to the lay mind because we bring in some of the best and brightest minds who are doing technical analysis. And my guest today certainly qualifies. Tom McClellan is the editor at the McClellan Market Report, which you can learn about at mcoscillator.com. And he is one of the more outspoken technical analysts. He has not been on the show since the end of January. A few things have happened then, but I'll point out that when he was on last, he was talking about liquidity concerns being overlooked by investors, but that they had him fully short at that particular time. We'll find out where he is and where he thinks things are going. And I know a little bit about where he thinks things are going. Buckle up. Tom McClellan, it's great to have you back on Money Life.
Yeah, I would say a few things have happened since last January. That's a fair statement.
They have. So let's start by just getting you've been fully short. We've had a year that's had plenty of bad headline news, et cetera, but where are you now?
Right now, neutral, seeing bad signs and good signs, and it's not clear which side of that battle is going to win. We had bad signs when I was talking to you in January, and we got fulfillment of those bad signs with the tariff crash in April. I don't think that the tariff news out of the White House caused the decline. I would say that it amplified that decline. There was a decline that was going to happen anyway. It's just got nudged a little harder thanks to Trump rolling out all the tariffs on Liberation Day and crashing the market. But we saw a lot of strength coming out of that oversold low. And in fact, we had a very kind of a rare technical signal back in, I think it was May, called a Zweig breadth thrust, named for the late Martin Zweig, who created it. When you get gobs of breath coming out of an oversold condition, that is a sign that liquidity is coming rushing back in, and it's a good sign, and it was fulfilled, and we got a great summer. And the bullish factors were able to overwhelm the bearish seasonality during its normal seasonal week period from July to October. The market just kept on trending higher, and we only got one little minor sell-off October 9th and 10th. That was the extent of it. It was a scary couple of days, but the market was able to power through that. But now we're seeing a lot of bearish signs again, even as we're now transitioning into the period of bullish seasonality, and it's not clear which side of that battle of forces is going to win.
Let's talk a little bit about some of the forces you see, because you do look at a variety of different indicators. And one thing that you have been on record talking about recently is something that ominously goes by the name of the Hindenburg Omen. You're going to need to explain this one and what we are looking at.
Yeah, this has been getting a lot of attention lately. The Hindenburg Omen was created by a guy who's now passed away, James Mika. Really interesting guy. He was a blind mathematician and market analyst. So he did all of his mathematical work despite not being able to see the numbers on paper. He had to get help with that from other people, but he was a brilliant guy. He came up with this idea that came to be known as the Hindenburg Omen because he was working on trying to refine a prior signal developed by Gerald Appel, who's now also passed away. Gerald Appel created something called the split market sell signal. That would occur anytime the numbers of new highs and new lows on the NYSE both exceeded 45 on the same day. So that was kind of a rare thing. Normally, if the market's going up, you get a lot of new highs. If the market's going down, you get a lot of new lows. If you see a lot of both of them together, that's weird, and thus it's noteworthy. Well, Gerald Appel never adjusted for the changing numbers of issues that are traded, and we have a lot more stocks on the NYSE now than we did back when Gerald Appel created that signal. So in 1995, Jim Mika undertook a task to try to refine that signal by adjusting for the changing number of issues traded. He also wanted to filter it with some additional criteria. For example, he only wanted to get a warning of trouble if the market's in an uptrend. If it's already in a downtrend like the 2022 bear market, you don't need to warn me about trouble. I already know we're in trouble. I want to know about trouble that's coming when everybody thinks everything's fine. So he put in a filtering criteria that the New York Stock Exchange Composite Index had to be above its value of 50 trading days ago. That's just as a way of seeing that the market's in an uptrend. The third criterion that he added as a filter was that the McClellan oscillator that my parents created, that had to be below zero, meaning a negative depiction of what the acceleration is in breadth statistics. I did not create the McClellan oscillator. I was only 8 years old when they were first doing all that work, and so I didn't really help very much. But I've done a lot of work with the indicators that my parents created since then. And my dad, by the way, 91 years old, still alive, still working, helps me every day with the newsletter and the daily edition, sharp guy, and still coming up with great new insights. So that's the Hindenburg Omen that Mika came up with. You got new highs and new lows that are more than 2.8% of the sum of advances plus declines. The New York Composite is in an uptrend, and the McClellan oscillator is below zero. We have just had 3 official Hindenburg Omen signals just within the past week, and we're likely to get a 4th one as I'm looking at the market today, Thursday, November 6th. The day is not over yet, but it's looking like the numbers are shaping up to get a 4th one. That matters because you can get a stray signal that's just noise every once in a while, but when you start seeing a cluster of them all together, that has a more of a weight in terms of saying that this is something that's valid and we need to pay attention to it. It's not something that the market can't overcome. It is possible that a gush of liquidity coming in can overwhelm this and other bearish forces, but this is a warning signal that there's trouble.
Since you've been giving us the history, why is it called the Hindenburg Omen? The Hindenburg, it made 1 or 2 trips where it was successful and didn't have a problem, but obviously it was a disaster. When this doesn't avoid trouble, does it have to end in disaster? What do we learn from what happens after the omen is realized?
It's true. It does not have to end in disaster. There are many times where things resolve themselves and it's just fine. And that's why Mika put in that criterion that the McClellan oscillator has to be below zero. If the McClellan oscillator goes back above zero, then you don't worry about it anymore because you're no longer in a depressing breadth situation. The name came about because when Mika came up with this idea back in 1995, he presented it to a guy named Kennedy Gamage, who's now passed away. So I'm talking today a bunch of signals created by old dead guys, but Kennedy Gamage wrote a newsletter called the Richland Report, and Kennedy was a big fan of using the McClellan oscillator. And so Mika presented this idea to him, and Kennedy knew about a different signal called the Ohama Titanic syndrome, which was created by a guy named Bill Ohama, that also looked at breadth and clusters of bad statistics for new highs and new lows. So he already knew about the Titanic syndrome, and Kennedy had a flair for marketing. And so he said, why don't you call it the Hindenburg Omen, just as a kind of a knockoff of the Titanic syndrome? And so that's where the name comes from. But the important thing to know about these things is, if you go back to the last several decades, every major top, if you looked at a chart going back 40 years, pick out every obvious major top, you find the Hindenburg Omen at all of them. You also find it other times. So it works every time at marking major tops, but it also shows up other times that are not major tops. And so it's a warning of trouble. It says you have a condition for a major top, but it doesn't necessarily have to be one, which can be frustrating to a lot of people because you show them a signal and they want it to work perfectly all the time. That's not the world that we live in. So we have to deal with the complexity that the market throws at us. This is a warning that we have trouble right now. It's coming as the Fed is cutting rates, but we are coming off of a year when the Fed was way behind in cutting rates and causing damage because of that. Every day that they spent with rates higher than they're supposed to be, and the 2-year note yield tells us where the Fed funds is supposed to be, that causes damage to the economy, and we're seeing that damage showing up. My friend Peter Atwater talks about the K-shaped economy, where it's great for the people at the top who are owning stocks, but it's lousy for other people who have ordinary jobs and are suffering from inflation, and manufacturing is declining and food prices are not declining. And so you have a big difference, and that is showing up as a big stress. And those kind of stresses don't necessarily have to hit the stock market right away, but they do tend to matter.
As I was preparing for this interview, I went back and listened to a couple of our past conversations. And one of them in 2023, you were talking about how you expected us to be in for a long period of economic trouble. that there would be great trading opportunities within the downturn, but you thought that there was going to be a lot of pain to digest before the real recovery could begin. Obviously, the market has gone gangbusters mostly since 2023. Have they just pushed out the pain? In other words, is everything still coming, or have conditions changed to where something has changed that makes that long-term forecast different now?
Well, let's define some terms. What was long-term? In the decadal sense, yeah, we're in for a lot of trouble on a decadal sense because we boomers are retiring, and we all expect to be supported in the manner to which we have become accustomed. And so we would like all you young kids to buy all of our stocks and bonds from us and provide us the income to live off of in retirement. So please get to work and provide us all we need and buy all our investments from us and buy our McMansions from us and keep us happy. That's obviously in conflict because boomers are high in number and the other generations are not quite as high. And so you have a generational problem there that's going to affect us. You also have a problem with the Fed thinking that they know better than the bond market at what should happen and keeping rates overly tight, which causes damage. So for about the next 15 years, it's going to be a great environment to be a market timer. It's not going to be a great environment to be a buy and hold investor like the last 15 years have been. So that's for the really long term. For the next year or so, we are now entering into the second year of a presidential term. Second years are typically when bear markets happen. And the most recent one of these was 2022. That was a very, very typical second year bear market. Other times when it's a very regular occurrence. So in fact, I've written a lot about the presidential cycle pattern, which goes at length in discussing this. You have to get through the second year, which is the pre-midterm election year, to get to the good times, which is the third year of a presidential term. Every time, except for 1931 and 1939, that you're in a third year, it's a bull market year. So 2027 is looking great, but we've got 2026 to get through first. And the first half of it, seasonality should have a bullish effect on it, which is being counteracted by some bearish effects. And it's not really clear whether seasonality is going to be strong enough right now to overcome those bearish effects. But by this time next year, it should be a great buying opportunity for catching that third year uptrend. The third year tends to be a bull market year because when you have a new president in office, especially who's from a different party than the last term, what they typically do is they spend the first year or so discovering that, oh my gosh, things are even worse than I told you. And the only solution is whatever they're trying to get Congress to do, either spending or tax cuts or something. The Inflation Reduction Act, the infrastructure bill, we saw Biden do that. The best example of that was in 1993 when Bill Clinton took office, and he encountered an economy growing at 5% and declared it was the worst economy in 50 years, and that the only solution was about a $20 billion package of pork spending that he wanted to get Congress to do. and $20 billion, that's a cute little number now. But Congress wisely said, no, we're not going to reward all your campaign contributors with this pork spending, and the economy ended up doing fine. But all the presidents do it. Trump does it in his own style and manner, but he does the same thing. When you get to the third year and they start running for re-election or for election of the guy who's from their party that wants to replace him, then they start declaring victory for having solved all the problems that they encountered during the first couple of years. And so that's why the third year tends to be an up year, because investors like hearing good news. They like declaring victory over problems solved. But in the first year or two, they don't like hearing that things are worse than we thought. And they don't like Washington getting activist in terms of trying to fix everything. Those are the things we have to go through right now.
You know, you talked about the Hindenburg Omen. You also talked about Titanic syndrome. And Titanic syndrome has been triggering right along with Hindenburg Omen this week. So I got to ask, when both of them are triggering together, does that increase the likelihood that there's your signal, there's your sign of a top?
It does. They're kind of measuring the same things. And so there's a little bit of duplication of what you're measuring. It's like if you look at your speedometer in your car and you stick your hand out the window, and you can tell you're going fast. Well, okay, you were measuring the same thing. So there's a little bit of overlap. The point is, it's not usual to have new highs and new lows both be posting high numbers. That's an unusual condition, and it's a noteworthy condition because it is unusual. It says there's something weird going on, and history has shown that this weird indication has shown up at really, really, really important times. It's also showed up at other times that are not nearly as calamitous. So take it as a warning that there are problems. It's not necessarily a sell everything and move into a bomb shelter time, but it's a time to be wise about it and look for other confirming signals. The more of these Hindenburg Omen signals that we get, the more important it is. We had 8 of them in a tight cluster in early 2000 early 2020, before the COVID sell-off. Now, the government shutting down the economy over COVID amplified that signal and its effect, but the setup was already there. We had 4 of them in late December of 2021 before the bear market of 2022. So these things tend to show up at important times, but it's not a guarantee.
Tom, great stuff. I really appreciate you joining me on the show to talk about it all. We're not going to wait quite so long before we get you back as we see how it plays out. Thanks again for coming on Money Life.
Fair enough.
That's Tom McClellan. He's the editor of the McClellan Market Report, keeper of the MC Oscillator, the McClellan Oscillator. You can learn about it at mcoscillator.com if you are looking for more information. And if you're looking for more of Money Life, we'll be talking with Sam Toombs, chief U.S. economist for Pantheon Macro, when we come back with the big interview right after this message.
Exchange is more than a finance conference. It's a community. Join us to gain insights and connections that last. Visit exchangeetf.com.
Welcome to the big interview on the November 7th edition of Money Life. Joining me now, Sam Toombs. He is the chief U.S. economist at Pantheon Macro. And if you are not familiar with the firm and you want to make yourself familiar, pantheonmacro.com. By the way, while you're there, you can get a free trial if you want to be getting Sam's take on things, which is very interesting, as you are about to find out. Sam Toombs, thank you so much for joining me on Money Life.
Thank you for having me, Chuck.
I want to start with the fact that as I've been reading more of your commentaries, I don't know that skeptical is the right word. You have a different take on a lot of the economic numbers than a lot of the people I have been hearing from, where they are genuinely saying, yeah, things can't get that bad if this is your underpinnings. You are questioning the numbers and the underpinnings. So help us understand what you are seeing in the numbers that it appears that others are not seeing in the numbers.
Yes, well, as you can tell from my accents, I'm British. I'm not based in the US, although I do travel as frequently as I can. And I think that gives us a little bit of a different perspective to many other commentators. We are focused, very much on the numbers. We don't have any political views. We don't have any strong views in that regard, but we're very much focused on the numbers as we see them come in, interpreting them through a historical lens. We like to look back over previous cycles as well. History doesn't, of course, always repeat, but it does rhyme. And we can see, across countries as well, patterns emerging. So at Pantheon, we don't just look at the US economy, but we look at a variety of other regions as well. And that does give us a slightly different perspective than many other economists and analysts looking at the US. And right now, we see an economy that is struggling. No, it's not close to recession, but I think in GDP growth is probably more like 1% rather than the 3% rates that are being reported right now by the latest official data that we have. The labor market usually gives you the better signal as to what's happening in the economy. And there we can see, employers being very cautious, jobs growth slowing, and many of the forward-looking indicators that we track from surveys in particular now look very soft. So I think we're in a slow growth phase for the economy. That's likely to persist at least for the next 6 months.
At the end of that 6-month period, if we're not as well off and not as healthy as we thought we were, what would pull us out of it? Because there's plenty of things that could push us deeper into it, but what would pull us out of it?
Right now, businesses and households are experiencing this tariff price shock, which is filtering through gradually to households. Businesses are trying to pass on month by month a bit more of the additional costs to households. And they are, gradually getting there. We've had about 6 months now of unusually fast increases in goods prices. And I think we've got another 6 months to go. Thereafter, inflation will start to come back down again. There are no signs, thankfully, this time around that tariff price shock is going to be persistent or have sort of second round effects, as economists like to call them, on wider price setting in the economy. Services inflation has been slowing this year, and goods prices outside of those ones that have been affected by tariffs are still flat. So really, there seems to be a short-lived burst of high inflation caused solely by the tariffs, and inflation will come back down next year, alleviating some of the pressure on households' finances. So in that sense, there is some hope, on the horizon, around 6 months away. In addition, households do have some tax cuts to look forward to next year. The One Big Beautiful Bill Act, of course, did unlock some tax cuts for a wide variety of different groups. In the round, we estimate that they will boost households' incomes by 1% next year. And many low-income groups will benefit from those tax changes, unlike those in previous administrations. So there is that additional boost to consumer firepower coming midway through next year. And then we also hope that the Fed will be able to continue its easing cycle next year. We think rates could be down to 3% by this time next year, a further 100 basis point reduction compared to where we are right now. And many households won't benefit from that directly because they already have low mortgage rates, that they fixed in 5 years or so ago. But for those homeowners who have just purchased in the last 2 or 3 years, have mortgage rates of around 7%, they will be able to refinance over the next year. They will see some, a boost to their cash flow, and that will provide the economy with some momentum. So there are some things to look forward to next year, but I think we still have another 6 months or so to get through first, where households' real incomes are flat. Employers are still very cautious with their hiring, and inflation is still undesirably high.
What it sounds like you just said is that, we're going to see the rate cuts. And oh, by the way, Treasury yields are coming down significantly with them. Is that in that forecast? Because that is not something I'm hearing from everyone.
Yes, we think the 10-year Treasury yield will likely be down to around 3% by the end of next year, so falling from above 4% at the moment, and that will be helping to bring down mortgage rates. I think markets are still worried about inflation at the moment, given that it is rising, being boosted by the tariffs. But we see it as very much a temporary period of high inflation, and that once the tariff costs have been passed on to households, inflation will start to come back down again next year. Services inflation looks like it's on a permanently slowing trajectory now. Many forward-looking indicators of wage growth look very soft, suggesting that employers now have the upper hand in wage bargaining, and next year will be slowing growth in wages and therefore able to slow increases in their prices as well next year. Within the CPI, there's a big component coming from rents as well, which have been rising quickly the last few years. But as a result of all of the curbs on immigration this year, we've seen much slower increases in new rents, and that will filter through into the CPI over the next year and help to bring down services inflation as well. So in terms of the outlook for inflation around 12 to 18 months' time, we think it's going to be quite low, coming back down again towards 2%. And that will ease the bond market's fears about inflation being a permanent problem for the US, and also enable the FOMC to keep easing policy until they get to where they think neutral is of around 3%. So we do see a big decline in yields coming next year as that inflation anxiety unwinds. That peak in inflation is now only a few months away. And then towards the end of next year, we'd expect to see inflation coming down quite quickly towards 2%.
You were talking about the impact of tariffs. You have an interesting take on what's been happening with tariff revenue. You believe the tariff revenues are very different from what has been reported or talked about. So what do you think is happening with tariffs, and how much of the trouble that we could be facing would be there if tariff revenues fall way short of projections?
At the moment, those tariff revenues are falling short of the White House's projections. For the last few months now, tariff revenues have been stable at about $35 billion per month. And that annualizes to around $400 billion. And that is well short of the Treasury Secretary's predictions back in August, when he told a White House cabinet meeting that he expected those tariffs to be raising well over $500 billion, maybe towards $1 trillion number. With these tariff revenues, yes, they've kicked up dramatically compared to a year ago, but they are not quite raising yet the revenues that had been expected. Now, it is hard to decompose exactly why these tariff revenues have undershot projections, particularly because we don't have US trade data now for the last few months because of the government shutdown. The latest data we have on a sort of granular basis for trade by different countries and by commodities is only available at this stage still for July. And we, of course, have had tariff revenues now all the way up to October, which we can monitor. And it's difficult to therefore decompose why those revenues have fallen short. I think the most likely explanation is that trade has been very nimble this year and has moved very quickly towards countries that have been lower tariffed. And China obviously has the highest tariff rates at the moment. But I think trade has likely shifted quite quickly away to other emerging markets. Many Chinese produced goods are likely being rerouted via third countries to avoid the very highest tariffs that are currently being imposed. And that is probably the biggest factor here as to why tariff revenues are not picking up to quite the extent that the White House had expected. I mean, that's good news, though, in a sense, for businesses. There's less of a price shock that they're experiencing than we'd all anticipated at the start of the year. Ultimately, good news for households as well, who eventually will end up bearing the brunt of the tariff costs. We've been able to revise down our forecast for inflation a little bit because those revenues just haven't come in quite as high as everyone had expected.
You talked about the issues that you think we are going to see and where they could ease up next year. Why are we not having recession, and why are we unlikely to have one for a while? Because recessions are normal. We expect them to come every now and again. You don't need a bear market to trigger a recession or a recession to trigger a bear market. We haven't had a bear market for a while, and we haven't had a recession. We've gotten to where people were expecting one, and every time they expect it, something changes, and then it's not coming. So why are we not going to get a recession?
Well, I think there are two reasons why we're not seeing a recession materialize at this stage. It looks to be a period of slow growth, but thankfully no contraction in activity. The first key reason is that private sector balance sheets are still in reasonable health. You haven't been on a sort of corporate borrowing binge for the last 2 or 3 years, and households have been very cautious still with the management of their finances overall, and their savings still look broadly in line with long run average levels compared to incomes. Debt levels have come down in both the household and corporate sectors in the last few years. So there hasn't been this overextension in the last few years. People haven't been living excessively beyond their means. Corporates haven't been overly optimistic and have splurged lots of money on investment that may or may not pay off. So we're not starting from a position where businesses and households have been risking too much and are now having to retrench. In addition, I think the second factor here is that AI and related investments in that area is helping to support the economy. It's not the only source of growth. You may have seen, on social media, many charts suggesting that AI investment by businesses is the only reason why GDP is rising this year, but that's not the case. But it is giving a boost to GDP growth of around 0.5% annualized on our calculations. About half of that is coming from investment actually by businesses in equipment and in data centers and all the related investments that have to go alongside that, such as improving the power grid. And it is true to say that a lot of that equipment is imported, so we have to subtract that boost to GDP growth as a result, because of course GDP is measured taking away imports, and so some of that boost is leaking out to other countries rather than being captured solely in the US. When you take account of that, it looks likely to be a boost to GDP growth of around 0.5%. Half of that coming directly from business investment, and another half coming from higher spending by households than otherwise would have been the case, given the big increases in stock prices we've seen this year. High-income households are still seeing this very positive wealth effect coming through, inducing them to spend a bit more. So, that is a very fortunate for the US at this stage, that at a point when there are other adverse shocks hitting it, such as the tariffs and wider government policy uncertainty, there is this AI story which is playing out and giving a modest boost to GDP growth. Those two factors together, really, resilient private sector balance sheets and the AI rollout, is really helping to prevent the economy from dipping into a shallow recession.
I don't ever spend much time asking economists about the market because they're focused on the economy and not the market. But I spend a lot of time asking guys who talk about the markets their take on valuations here versus valuations international. We've seen great things out of international stocks, our international stocks here when it comes to their performance this year, but there's a split between the investment guys on whether it's all about currencies or whether it's really about a rally, et cetera. I'm curious what the view is over there. I recognize that you focus more on the economics than the market. And yet, as you are helping Pantheon do its job and you are talking to customers there, what do you say about valuations with a market that has been this high this long and a market there that is better valued but not doing as well as this market?
Well, it's been a very interesting year because, of course, for the first half of this year, really, the story was that overseas investors became very cautious about lending or investing in the US as a result of the heightened policy uncertainty. So we saw European equities, for once, stage a bit of an outperformance, and global investors generally underweight in their portfolio allocations the US, whilst all the tariff story remained so uncertain. And also the new administration was threatening in many ways the independence of the Federal Reserve. We saw at times when that was being questioned by the new administration and the performance of US assets, the dollar weaken. Most of that has now unwound this year. In the second half of the year, investors globally now feel that they have more certainty around that tariff story. We haven't really had much changing in the last few months on the scale of those tariffs. And the president, of course, has also backed down from some of the threats to remove Chair Powell from his position early. That has reassured markets, and we've seen in the last few months overseas investors then really wanting to just get back into the US and capture some of that AI play and investment there that's going ahead. I think it still is a very fragile situation though, in that there are many bumps in the road still potentially to come in terms of the Federal Reserve's independence. That will still be a question going forwards for overseas investors over the next 3 to 6 months, in particular leading up to the appointment of the next Fed chair, which must happen by May. We know, of course, that President Trump and many in the White House would like to get interest rates down quickly over the next year. And if there's any sense, I think, with the new appointments that the Fed is losing its independence and that there's a race to reduce interest rates very, very quickly over the next year at the sort of request of the president, then that could lead to a renewed period of caution by overseas investors and US assets generally underperforming like we saw in the first half of this year once again. I think that's unlikely. I think, just changing the Fed chair is not going to shape future interest rate decisions going forwards because it's a committee of 12 people voting. It seems more likely than not as well that there is little scope for the administration to have an impact on the wider setting of or the wider composition of the committee going forwards. So we're still reassured that the Fed will remain independent regardless of the change right at the very top of the committee. And I think, we've seen it at times in the last few months as well, the new administration take a more sensible sort of conservative approach to appointments on the Fed and to, whenever markets have expressed their dissatisfaction with the administration's approach to the setting of or the overreach into monetary policy, the White House has somewhat retreated from those positions. So, looking ahead, we think that the US equities will still perform relatively well. They won't be lagging behind the rest of the world like they did in the first half of this year. But it is subject to those political factors, which remain hard to read. Of course, overlaying that as well, you have the uncertainty around the AI story and whether it really will take hold, whether businesses will find use of the AI that is currently being developed. That remains very much an open question and is, of course, pivotal to whether US stock prices more generally continue to outperform relative to the rest of the world.
Well, Sam, we always leave open questions because we have more interviews to do down the line and we want to be able to ask them. But this was a great debut, and I look forward to asking you more questions when you come back on the show next year. Thank you so much for joining me on Money Life.
Been a pleasure. Thank you.
That's Sam Toombs. He's Chief U.S. Economist at Pantheon Macro. It's pantheonmacro.com, just like it sounds. You want more information. And we're going to come back, put a bow on this show, and this week on Money Life, we'll set you up for what's coming next week right after this message. Stick with us till the end.
Hey Money Lifers, it's Rob Floyd, the show's executive producer and normally the contest master. This week, however, Chuck has come up with his own contest for 3 interesting books he discussed on the show. Those books are My Mother's Money, A Guide to Financial Caregiving by Beth Pinsker, who was on the November 4th show. The Perceptive Investor, The Art, Science, and Temperament of Successful Value Investing by Arda Low-Groninger from November 5th. And Soldier of Fortune, Warren Buffett, Sun Tzu, and the Ancient Art of Risk-Taking by Tobias Carlyle, who appeared on the November 6th show. To win the books, you have to tell us Warren Buffett's 3 largest holdings in Berkshire Hathaway. Give them to us in order, please, as the name of his largest holding gets you entered to win My Mother's Money. His second largest holding gets you an entry for The Prospective Investor, and the third gets you a shot at Soldier of Fortune. Send your entries along with your name and address to chuck@moneylifeshow.com by 7 p.m. Eastern Time on Thursday, November 13th to enter. And please put the word contest in the subject line of your email. Chuck will announce the winners on the Friday, November 14th show. Good luck, everyone.
So it's another week already.
I don't know where the time goes. I really don't. It flies when you're having fun. We've been having a lot of fun. I can't believe that I'm setting up interviews for the end of the year, talking about outlooks and things along those lines when it feels like, aren't we just starting this year? Like last week? Wow. Time does fly in this show too, and we've actually run over, so we're going to keep this very tight here at the end. But we have big things planned for you for this month, next month, etc. We're always planning big things. Really interesting interview coming for you on Monday. Sal Gilberti, Chief Executive Officer at Teucrium Trading. They do commodities trading, and they have commodities-driven ETFs like SOYB. SOYB. We'll be talking about that. But also next week, Stuart Katz, Chief Investment Officer at Robertson Stevens. Steph Guild, Chief Investment Officer at Robinhood. Tanya Fakui, who is Senior Director in Global Economic and Market Strategy at MetLife Investment Management. That's all among our big interviews next week. Plus Mark Travis from Intrepid Capital, talking technicals. Peter Krull, Director of Sustainable Investing for Earth Equity Advisors, makes his debut in the Market Call. Mike Dixon from Horizon Investments makes his debut in the Market Call. So stuff like that. And speaking of debuts, I'm excited for Matthew Timpain, Senior Market Strategist at Schaefer's Investment Research. He makes his debut in the in Talking Technicals on Tuesday. Plus, we've got Buck Clintworth from Chase Investment Counsel coming at the end of next week, Talking Technicals. All that and much more, so lock us in. By the way, we've got that great contest going for 3 different books. Get involved in that. Meanwhile, if you are looking for something to celebrate, this one is personal to me. It is National Canine Lymphoma Awareness Day, which actually wasn't a thing until 2015. But I was very aware of canine lymphoma before that. Because while you, if you listen to the show, know that obviously I have Maho now, I had Frio before this, my first golden retriever was a dog named Fripp. And Fripp was an incredible dog. And remember, I was mauled by a neighbor's dog as a child. I never really expected to have one as an adult. Well, Fripp cured me of all that. But Fripp had lymphoma and died very, very young. We caught it as early as we could. We treated, we did everything we could, but there was nothing we were going to be able to do. But I will point out that if you have a dog, this is one of the reasons why you put hands on that dog every day. And it's not just, I want to pet my dog because I love it. No. Hands, feeling for things and trying to make sure, because that's what we were able to do. And we were at least able to extend his life. So I encourage you, if you have especially a breed like a golden retriever, which is what Fripp was, National Canine Lymphoma Awareness Day, do the right things. It's also National Fountain Pen Day. It is National Jersey Day, which is really about NFL jerseys, but there's no reason you can't wear your favorite. It is Hug a Bear Day, which I at least hope is about teddy bears and not other bears. Maybe it's Chicago Bears. They do it in a jersey. It's National Bittersweet Chocolate with Almonds Day.
Chocolate.
And you can wash that down with some Merlot because it's International Merlot Day.
To alcohol, the cause of and solution to all of life's problems.
That sentiment seems common to me for people who really love Merlot. My guests today were Seth Brufsky, Chief Executive Officer at Ares Dynamic Credit Allocation Fund, ARDC, the ticker, arespublicfunds.com. Tom McClellan of the McClellan Market Report, mcoscillator.com. And Sam Toombs, Chief U.S. Economist at Pantheon Macro, pantheonmacro.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly, thanks to you for being here, because you make this special and worthwhile for me each and every day. The Money Life quote of the day comes from Anthony Ramos, the actor, who said, "Success is doing what you love and loving people while you do it." Well, yeah. So hopefully you are successful in so many ways, but it's a weekend, and really go out and be successful. Spend the time with the people you love and doing what you love to do, and that will keep everything in perspective and help you remember that until we do this again the next time, best thing you can do for your money is not worry too much about it. Have a great weekend, everybody. Stay safe and calm. We'll see you here again on Monday.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
Looks like I picked the wrong week to quit drinking.